Hello and welcome to the fourth video of our video tutorials on the basic concepts of trading. In this tutorial today, we will be covering the topic of rollovers. Through this video, we aim to help better understand the often confusing process of how the rollovers work and the associated swap charges. So to start with, what is a rollover? Rollover is the practice of carrying over the open trade positions with the spot value date to the next value date. This is done for trade positions that are held for more than one trading day. So for all the open trades on your trading account which you carry over to the next trading day itself, the process of transitioning them from one trading day to the next is what is known as the rollover. Now, since traders are not really interested in taking the physical delivery of the currencies traded, they tend to hold the trade position till the time that they finally wish to close the trade. This requires them to roll over their trade positions to the next value date or the next trading day. This process is performed every day that the Forex market is open until the trader finally closes his trade position. So how does this rollover work? Transactions in the interbank markets are one-day contracts, and each trade that is placed by a trader is assigned a value date to help identify those trades by the day that they were placed. Now, when the trade is closed, the value date needs to match up with the value date of the opening of the trade. In order to ensure that these value dates for both the closing and opening of the trade matches with one another, they need to be changed to the next subsequent trading day from the day that it was opened. This is done during rollover time every day, which is 2200 GMT. Let's consider an example to understand this better. Consider that a trader opens a trade position on Monday. Now, in the interbank markets, as explained, each Forex transaction would have an assigned value date to help identify that trade and the day that it was opened. This value date is also known as the settlement date. For Forex transactions, the trades are settled 2 business days following the day that the transaction is made. Thus, the value date for this trade position, which was opened on Monday, would be 2 days forward, that is, for Wednesday. Now, if the trader wants to hold on to this trade position and does not close it before 2200 GMT or 5 p.m. EST on Monday itself, his trade will be rolled over to the next trading day, that is Tuesday. And the value date for this trade will also need to be changed 2 days ahead of Tuesday, which would come out to be Thursday. Now, if the trader decides to close his trade on Tuesday before the rollover time of 5 p.m. EST, and since the trade has already been rolled over to Tuesday, so now in our example, the settlement date has changed from Wednesday to Thursday, and the value date for both the opening and closing of the order would match up as Thursday. Alternatively, if he still holds on to his trade beyond the rollover time on Tuesday again, then the trade will be rolled over from Tuesday to Wednesday, and the value date would move 2 days ahead of Wednesday, which is Friday. So the value date for the trade has again changed, and this will continue to take place until the trader finally closes his trade. It is important to note here that all the trade positions that are rolled over from Wednesday after the rollover time, that is 5 p.m. EST on Wednesday, to Thursday, the value date changes from Friday to Monday, and hence the swap rate applied will be triple the normal amount. This is done in order to adjust for the weekend when the markets are closed. Though the markets are closed, the banks still count these days, that is the weekend, for the interest rate calculations. Now that we have understood how the rollover works, we shall try to understand what are the benefits of rolling over the trade position. The major benefit of rolling over trade positions to the next trading day is the underlying interest rate associated with the currencies being traded. This interest rate is also known as the swap rate. When one currency pair has a higher interest rate than the other, then the difference between the interest rate can be earned by the trader. And this benefit can be significantly large for a leveraged trade position. This practice of taking advantage of the interest rate difference between the currencies of the currency pair traded is known as carry trade. Carry traders are traders who hold trade positions for a long period of time in order to take advantage of the interest rate earned on holding on to those positions. We will be discussing more about swap rates and how they are determined and calculated in the next video in this series of video tutorials. Hope this video was of use to understand the concept of rollovers better. Thank you for taking the time to watch this video.